Okay, let's use Excel to do capital budgeting techniques for a 5-year project. We'll show you how to set that up and conduct the analysis. So we often discount projects to find the NPV at the weighted average cost of capital. So I'm going to put in the weighted debt, the return we pay to bondholders or the cost of debt, the tax rate, the weight of preferred stock, the return we pay to preferred stockholders, the weight of equity, and the return we pay on, let's say it's retained earnings. Now remember from class, common stock financing could either be retained earnings, we have retained earnings available, or we're issuing new common stock. Here I'll assume we're using retained earnings on this spreadsheet to finance the equity portion of the project. And down here we could have the project itself. We could put year and the cash flow. And in year 0 we're going to outlay $650,000. So we're going to get $650,000 from bond and stockholders, and we're going to invest it in fixed assets, some sort of a project. Maybe it's a build out of leased space because we're opening a new Wawa store down at the shore. Whatever you want the project to be. Then we'll do a 5-year project, year 1, year 2, year 3, year 4, year 5. And I like to, center that. I'm going to highlight that and come up here and center it. Bold these two. Actually bold and center these as well. And then, so we're going to spend $650,000 of bond and stockholder money. We call that capital. And we're going to give them money back. After all other expenses are paid, in year 1, we're going to give bond and stockholders the project's going to generate us $175,000 for them. After cost of goods sold, operating expenses, and taxes are paid, we consider depreciation, there's $175,000 left to pay back those bond and stockholders collectively. For what? For the use of the money they gave us, $650,000. In year 2, it's $185,000. That's expected. It's $192,000 in year 3, $145,000 in year 4, and $140,000 in year 5. And so we expect this project to last 5 years. After 5 years, there'll be no more inflows. So I could highlight all of those and hit the dollar sign to make that look better. And that's actually a negative. I should come up here and make that a negative number. It's negative $650,000. That's the outflow. That's the investment of bond and stockholder money into fixed assets. And these 5 cash flows represent the return that go back to bond and stockholders collectively. Now let's say we're going to finance this project 30% with debt. That might be probably is our capital structure of our firm. And given we want to stay at that capital structure, we'll finance the new project 30% with debt. What does that mean? When we raise this $650,000, 30% of it is going to come from selling bonds. Let's say 10% is going to come from selling new preferred stock. And then we're going to use retained earnings. And what's left? 30% plus 10% is 40%. So 60% of the $650,000 is going to come from retained earnings. We're assuming that's available. The cost of debt is 5%. That's what our bonds yield. If we issue new bonds, we're going to have to yield 5%. The tax rate's 22% on debt. The cost of preferred stock is 7%. That's what we pay, the return we pay to preferred stockholders. And an appropriate return for our common stockholders for the use of the retained earnings, we're going to say is determined to be 10.22%. So now what I could do is I could come over here and calculate my weighted average cost of capital with the assumption I'm using retained earnings to finance the equity portion. Okay, so let's figure that out. We're going to take this number, put in equals this times that times 1 minus the tax rate, put that in parentheses, plus the weight of preferred stock times the cost of preferred stock, plus the weight of equity times the cost of equity, which is the appropriate return for unretained earnings. We've determined that to be 10.22%. And we hit enter. And so the cost of capital is determined to be 8%. Usually when we do NPV, we often use the cost of capital as a discount rate. Not always, but often. Given the riskiness of the project is about the same as the riskiness of the average projects the company already has, we're going to use the cost of capital. And we'll say that's true for here, but know that that could change. In more advanced problems, we could actually change the cost of capital. But here we'll use 8%. And so let's start. What are we going to do first? Let's do the payback method. We'll calculate the payback of this project. How many years does it take for the project to pay back? So I'm going to build a cumulative column. And I might come up here and wrap the text so it fits nicely. Make it bold, maybe center it. It looks better that way. Now the first entry of a cumulative column is the first entry of the cash flows. It's negative $650,000. We start $650,000 in the hole. We invest that much. We're down $650,000. The next, if you take the next entry is you take the negative $650,000, refer to that cell, here it's E6, and add the first cash flow. Now the firm is only down $475,000. It spent $650,000 of bond and stockholder money, and in the first year it earned back $175,000 of their money, so now we're only down $475,000. Now watch what you do. You come over here with the mouse, you left click, and you go down. And I get negative 290. And then you do it again. You get negative 98. And then you do it again. And you get 47,000. Once you get a positive number in the cumulative column, you could stop. And I'm going to highlight the last year the cumulative column was negative. I'm going to highlight the negative amount. And I'm going to highlight the next inflow. Now here's what you do for payback. It equals, in this case, 3, the last year the cumulative column was negative, plus the absolute value of that negative amount, in other words, we're going to ignore the sign, divided by the next cash inflow. I mean, you get a lot of chatter after the decimal point, so I'm going to come up here and click comma. So this project pays back in 3.68 years. That's how long it takes the project to pay back, 3.68 years. And so we'll leave that like that. And now I'm going to leave that alone. I'm going to come over here and I'm going to do, I guess I'll do IRR next. Yeah, that's next on the agenda. Okay, see how I copied this and pasted it here? I might double click, I want to double click the H column so that it shows the numbers instead of those pound signs. Those pound signs indicate there's too many numbers in there for the width of the column. So to widen the column, you just come up here and double click when you see this solid cross. Okay, now I want to get rid of this yellow. I don't want to carry that forward. Might confuse me. So here's IRR. In other words, I want to know if I spend $650,000 now and I get back these amounts in the future, what's the annual return of that? I don't know what that is, but Excel will tell me. What annual return would represent these cash flows? The negative 650 followed by those positive cash flows in years 1 through 5. So it's very easy. Put in equals IRR, open parentheses, left click up here, drag to the bottom, close parentheses. And then I'll scoot it out a couple decimal places. So this project's IRR is 9.51%. That is that project's IRR. So what I see happening here, the firm is obtaining capital, bond and stockholder money. How much? $650,000. It's obtaining capital, and it's paying on average 8% to use the capital. And it invests it in a project that yields, we can put that in bold, put this in bold, that yields 9.51%. And so I'm imagining, thinking, estimating that the NPV of this project is going to be positive. So we could do net present value next and see if that is indeed true. If I'm obtaining investment capital at 8% and investing it in a project that yields 9.51%, that's going to create value, dollars. NPV is the exact number of dollars this project creates. So we'll go here. Watch this, equals NPV. This is a little odd how this works. It asks for the rate. Now be very careful. We just calculated IRR, but that's not the rate we're going for. It wants the cost of capital. And then what you do is you put in the cash inflows only to start. So put in cash inflow 1, comma, inflow 2, comma, inflow 3, comma, inflow 4, comma, inflow 5. Close parentheses, and then add the negative outflow. Why it works that way, I don't know. I just know that that's the way NPV works in Excel. And you get $24,887.43. So indeed, we get a positive net present value, which makes sense. If you're going to obtain investment capital and pay 8% to use it, and invest at 9.51%, that's what the project returns. That's going to create wealth for common stockholders. And the wealth it creates is just under $25,000. That's the wealth it creates. Let's look at what's next here in the lineup. Next is profitability index. I'll just call that PI. And what I'm going to do here to calculate the profitability index is I'm going to take the equals, open parentheses, take the absolute value of the cash outflow in year 0. In other words, ignore the sign. Add the net present value, close parentheses, and divide by 650,000. In other words, the absolute value, again, of the cash outflow in year 0. And you get, it really shouldn't be in dollars, so I'm going to come up here and click this comma. So the cash out, the profitability index is 1.04, which we would expect whenever you have a positive net present value, the profitability index is going to be above 1. If ever you have a negative NPV, which you could have, you could easily have that if let's say the retained earnings was 15%, that would cause the cost of capital to be higher. Notice this, whenever you have a NPV of a negative amount, the profitability index is below 1. But let's set this back to what we were doing. Okay. And then the next thing we might want to do is, now this is based on the paper by Professor Larson, myself, in, when was it, like summer of 2018, in Advances of Financial Education. That was the journal that this in. And we estimate the return on retained earnings. And it's going to be higher than 10.2% because I have a positive net present value. So I could put this as the estimated return on retained earnings. And let's do this. It's equals, take the internal rate of return of the project and subtract the weighted debt times the cost of debt times, put in parentheses, 1 minus the tax rate, minus the weighted preferred stock times the cost of preferred stock, all divided by the weight of equity. And you get like a lot of chatter after the decimal point. So let's just click that. Maybe go out 2 decimal places. Let's make it a percentage. Go out 2 decimal places. And so what that's telling you is that when we select this project with this positive NPV, is that indeed bondholders will get a 5% yield. There's enough cash inflow here to give bondholders a 5% return. Preferred stockholders will get their 7% return. But what we just figured out is common stockholders, for the use of the retained earnings, they're getting better than 10.22%. They're getting 12.73%. So this project is one that we would accept. We'd be able to pay our bondholders a fair return, 5%. Our preferred stockholders a fair return, 7%. And to our common stockholders, they get better than a fair return. We've estimated the return to them to be 12.73%. They're going to give us, what, like 60%. The retained earnings is 60% of $650,000. We're going to take $390,000 from them, and we're going to get them at 12.73%. If, of course, all these cash inflows in years 1 through 5 come true, and if, of course, it really only costs us $650,000 in fixed assets to do this project. Of course, that all remains to be seen. So we've calculated payback, IRR, NPV, the profitability index, PI, and then we estimated the return on retained earnings. So this concludes the video on capital budgeting.